I mean, if you just glance at the S&P 500 today, it is flashing green, right? It's aggressively pushing toward all-time highs.
Yeah, totally. It looks great on the surface.
Right. Like if you're just looking at the major indices, you'd assume we're in this massive risk-on bull market. But, well, if you actually look under the hood at the trading volume today, it's a completely different story.
Oh, absolutely. It's night and day.
Yeah. The quote-unquote smart money is quietly selling off mega cap tech and hiding in utilities of all things. So today, we're really tearing apart the price action.
Which is so necessary right now.
Exactly. We need to show you the massive liquidity vacuum that institutional investors are secretly preparing for, how you can actually exploit algorithmic mispricing, and, exactly what actionable levels you need to be watching right now.
Yeah, because it is the absolute definition of a disguised market. I mean, the surface headline numbers, they look incredibly calm.
Deceptively calm, yeah.
Right, deceptively calm. But the structural currents underneath are violently shifting. And if you aren't tracking where the capital is actually flowing, I mean, you are basically flying blind.
So let's map out those currents. We've got a massive stack of quantitative flow data and real-time charts to get through. But I feel like we have to start with the broader indices.
Yeah, for sure. You have to start macro.
Because we are seeing a total paradox right now. On one hand, the S&P 500 and the NASDAQ, the QQQ, they are actively refusing technical breakdown signals.
Refusing them
Yeah,
completely.
like we saw what looked like a textbook diamond top forming on the NASDAQ, and normally that's a rare, highly reliable reversal pattern, right?
Oh, yeah, it signals massive indecision. Usually implies an impending drop.
Exactly. But the market just shrugged it off and pushed higher.
It did push higher, but you have to ask, what is pushing it higher? Because underneath that headline index strength, we are seeing some really bizarre sector movements.
Like what? What's standing out?
Well, utilities, for one. Tracked by the XLU ETF, they're up 5.8%.
Wow, utilities.
Right, and consumer staples are beating the broader S&P 500. Even the completely unloved housing sector is flashing green on days when, the rest of the market is just dumping on bad news.
Wait, let me make sure I have this mechanism right, because this is crucial for anyone listening. Usually when we look at the market cap weighted S&P 500, massive companies like Apple, Microsoft, NVIDIA, they just drag the whole index up, right?
Yeah, they do all the heavy lifting.
And that kind of masks the fact that hundreds of smaller stocks might be bleeding out. But right now, the data shows the equal weight S&P is vastly outperforming the market cap weighted version.
Vastly outperforming, yes.
So that means the tech giants are the ones dragging their feet, right?
Precisely. I mean, in an equal weight index, the smallest company has the exact same influence as the largest one.
Right.
So if the equal weight is surging while the market cap index struggles, it tells you institutional capital is broadening out. The mega cap tech stocks, the Magnificent Seven, they're no longer carrying the market alone. In fact, they're actually acting as a source of funds.
A source of funds. Okay, it's kind of like, well, think of a homeowner who decides they absolutely have to buy this multi-million-dollar vacation home.
Right, okay.
But to afford the massive down payment, they have to quietly sell off all their reliable high-end furniture. Why are institutions suddenly selling their most reliable tech winners just to raise cash?
Because of an unprecedented liquidity drain sitting right on the horizon. I mean, we are looking at a potential SpaceX IPO combined with looming initial public offerings for AI heavyweights, like OpenAI and Anthropic.
Oh, wow. Yeah, those are massive.
They're huge. These aren't normal market debuts. These offerings are going to require hundreds of billions of dollars to absorb.
And there's only so much cash to go around.
Exactly. Institutional investors only have so much cash on hand, so to buy into these generational tech offerings, they literally have to liquidate their highly appreciated assets.
But it's not just domestic IPOs sucking all the liquidity out of the room, is it? Because the flow data we're looking at shows a massive macroeconomic shift happening with Japan, too.
Yeah, the Japan situation is huge.
Right. Japan's government pension fund, which, by the way, sits on something like $1.8 trillion, is aggressively tilting toward domestic assets. Walk me through the domino effect there. How does a Japanese pension fund moving money around actually hit, say, a U.S. tech portfolio?
So it all comes down to the mechanics of the bond market. Japanese investors are actually the largest foreign holders of U.S. Treasury bonds.
Okay.
When the Japanese government needs capital to fund its new $2.3 trillion 14-year fiscal policy plan, which, by the way, is heavily focused on AI and semiconductor manufacturing.
Right, they need cash.
Yeah, they have to repatriate their money. So they stop buying U.S. debt, and they start actively selling the U.S. bonds they already own.
And obviously, when you flood the market with U.S. bonds, the price of those bonds drops.
Exactly. And when bond prices drop, bond yields go up.
Oh, and yields are everything for tech.
Right. Rising risk-free yields are basically structural kryptonite for highly valued tech stocks.
Because of how they're valued, right, based on future earnings.
Yes, a tech stock is valued based on its future cash flows. When the yield on a safe, government bond goes up, those future tech cash flows are discounted at a higher rate. It just makes the stock mathematically less attractive.
So you have this brutal 1-2 punch. Institutions are selling tech to buy SpaceX, and Japan is selling U.S. bonds to fund domestic AI, which drives yields up in the process.
Yep, it's a perfect storm.
Which completely explains why the smart money is hiding in utilities and boring dividend-paying stocks. I mean, they see this liquidity vacuum coming, and they are just playing defense.
Exactly. They're buckling up.
So if institutional capital is quietly rotating out of tech, how is that selling pressure actually manifesting on the charts? Let's give you guys some specific actionable levels where this rotation is hitting a wall.
Yeah, let's get into the charts. If you are trading the S&P 500 futures, the ES, you are staring at a massive supply resistance zone right at 7613.
7630. Got it. And what about the NASDAQ?
For the NASDAQ futures, the rejection zone is perfectly defined. It's right between 29,923 and 30,077.
And for those who might need a refresher, a supply zone is essentially a historical graveyard for buyers, right?
That's a great way to put it, yeah.
It's the exact price level where institutional sellers have previously stepped in to just unload massive amounts of inventory, which ends up trapping anyone who bought late.
That is the exact psychology of it. When price approaches 7613 on the S&P, you have institutions just waiting to sell. It creates a literal brick wall.
So what's the rule for traders here?
The rule is entirely binary. If the price pushes through that level on high volume and holds, it's a legitimate breakout because it means the sellers are exhausted.
Right, the ball broke.
But as long as those levels hold as resistance, you just have to accept that we are trapped in a tight, choppy, mean reverting range.
But even in a choppy range, there are always isolated setups, right? Like the price action data we're looking at highlights a couple of really clear higher time frame opportunities.
Oh, absolutely.
Like Palantir, ticker PLTR. It's printing a very clean higher low and holding strongly above its daily 50 simple moving average. And it looks like the structural target is 140.
Yeah, Palantir looks great.
But the one that really caught my eye is Google, ticker GOOG. It's flashing a pullback long opportunity between 354.20 and 354.70.
That's a really interesting zone.
Yeah, it's retesting its daily 20 SMA and forming a classic inverse head and shoulders pattern.
I love that setup. The inverse head and shoulders is honestly one of the most reliable bottoming formations you can find, specifically because of the human behavior it represents.
Walk us through that behavior. What's actually happening there?
So you see sellers try to push the price down to a new low, right? That forms the left shoulder.
Okay.
Then they rally and then push it down even harder to a deeper low, forming the head. But on their third attempt to crash the price, they just fail.
You run out of steam.
Exactly. They form a higher low, which is the right shoulder. They literally run out of ammunition.
Yeah.
Buyers realize the selling pressure is completely exhausted and they step in to take control.
That makes total sense. Now, I want to pivot to something that absolutely blew my mind in the price action data today because it shows just how flawed modern trading algorithms can be.
Oh, you're talking about DigitalOcean.
Yes. DigitalOcean, ticker DOCN, we saw a 16% intraday collapse. I mean, the stock plummeted from 134 down to 112 in a matter of hours.
It was a brutal drop.
And the trigger was just a press release stating the company was repurchasing $500 million in convertible notes, and they were funding it by a concurrent stock offering.
Right.
So algorithms basically scraped the word stock offering, assumed massive shareholder dilution, and just blindly dumped it. But when you actually read the SEC filing, the real dilution impact on the share count was literally zero.
Literally zero.
How is that possible? How does a company issue hundreds of millions of dollars in new stock without actually diluting the shares?
It's because of this brilliant piece of financial engineering called a capped call, which, as we just saw, algorithms fundamentally struggle to price in real time.
Okay, what exactly is a capped call?
So when DigitalOcean originally issued that convertible debt years ago, they knew it could eventually dilute their shareholders if the stock went up. So they simultaneously bought capped calls. Think of a capped call as an options contract that gives the company the right to buy their own stock back at a predetermined lower price.
Okay, so walk me through the math of how that actually offsets the new shares hitting the market today.
Sure, when it's time to pay off the debt, DigitalOcean does issue new shares, but simultaneously, they exercise those capped calls.
Ah, I see.
Yeah, the massive profit they make from those options contracts, because their stock price has naturally risen, completely pays for the new shares they are issuing.
That is wild.
The cash generated by the capped calls perfectly offsets the $436 million actual cost of the repurchase. The dilution was already accounted for and mathematically neutralized quarters ago.
So the net economic effect on the company's valuation is completely 100% neutral. Yet, because these trading algorithms just lazily scrape PR wires for keywords, they initiated a mechanical panic sell-off. A fundamentally unchanged company goes on sale for a 16% discount purely because machines don't read the footnotes.
It's crazy, but it is the ultimate proof that mechanical mispricing still exists. When an asset drops 16%, not because of changing fundamentals, but because of a mechanical trigger in a computer program, that is a dislocation you can exploit.
Which brings up a fascinating dynamic, because if algorithmic blind spots are creating false discounts in heavily regulated equities, you'd think a purely speculative, highly leveraged market like crypto would be seeing massive volatility as this Japanese liquidity vacuum approaches.
We did think so, yeah.
But when you look at the actual smart money flows in crypto right now, it's not what you'd expect at all.
Not even close. If you want to gauge the true health of speculative risk appetite, you look at Bitcoin. And right now, the price action is incredibly cautionary.
Yeah.
Bitcoin is just hovering below both its daily and weekly moving average clouds.
And for anyone who doesn't use the cloud system, we're basically talking about a dynamic zone of historical value, right?
Right, yeah.
It's where trend-following institutions typically step in to defend their positions. So if price is stuck below the cloud, it means no one is stepping up to defend the asset.
Exactly. It shows a complete lack of institutional urgency. And the ETF flow data totally supports this. It's been flat to outright negative for weeks.
But the real kicker is the COT data, right?
Oh, absolutely. The most glaring warning sign is hiding in the COT data, the Commitment of Traders report. The commercials have been historically net negative since the beginning of the year.
We need to define commercials here, because we aren't talking about day traders on Reddit. The commercials in the COT data represent the actual corporations that use the futures market to hedge their real-world business risks, right? Like Bitcoin mining companies or major exchanges.
Yes, they are considered the ultimate smart money because they aren't gambling. They have the deepest pockets and the absolute most intimate fundamental insight into the asset's production costs.
So what does it mean when they are net negative?
When commercials are historically net negative, it means they're heavily shorting the futures market to lock in current prices because they're actively preparing for the spot price to fall.
Wow. And you add to that the fact that the DXY, the US dollar index, is breaking out to multi-month highs. A strong dollar is a structural headwind for risk assets. Bitcoin is priced in dollars. If the denominator of that equation, the dollar, gets stronger, the nominal price of Bitcoin inherently goes down.
Yeah, it acts like a gravitational pull on everything pressed against it. And you combine that strong dollar with the fact that August and September are historically terrible months for crypto seasonality anyway, especially in a midterm election cycle.
Okay, so I have to push back on a dominant narrative here, because if you log onto any social media platform right now, every influencer is screaming to buy the dip just because Bitcoin pulled back 10%. But if the dollar's acting like a wrecking ball, seasonality is historically terrible, and the actual miners, the people creating the asset, are heavily shorting it. Trying to buy the dip right now feels less like catching a falling knife and more like trying to catch a falling safe.
That's a great visual.
Right. So why is retail so desperate to front-run a reversal instead of just waiting for the charts to actually confirm a breakout above those moving average clouds?
Honestly, it's a psychological trap. Retail traders obsess over catching the absolute stone-cold bottom because it feeds the ego. It feels like a massive victory to say you bought the exact low. But institutional positioning clearly indicates a wait-and-see approach. The reality of trend trading is that the safest, most profitable 80% of a rally happens after the trend is established.
You don't have to be the very first one in the door.
Exactly. You don't need to catch the exact bottom to make incredible returns. You just need to let the market prove its direction and then jump on board when the train leaves the station.
That being said, if you dig into the underlying altcoin volume, you do see some weird, isolated pockets of technical strength, don't you? Like Zcash, for instance. It's forming a massive cup and handle pattern that structurally targets a 600-point move.
Yeah, Zcash is interesting. The cup and handle is a beautiful psychological pattern. You have a
Mhm.
long, rounded bottom cup where early sellers are slowly exhausted and replaced by steady, quiet accumulators.
A handle.
Then you get a brief, shallow consolidation of the handle where the last weak hands are just shaken out before a massive upside breakout. It shows deep institutional accumulation.
And there's also a token called Bull, forming an inverted head and shoulders above its moving average cloud, despite being down 50% since last September.
Right.
So specific narratives can clearly buck the macro trend, but your point stands. When the smart money is overwhelmingly negative on the macro asset class, you don't blindly step in front of the train.
No, you tread incredibly carefully.
So, if tech is facing a massive IPO liquidity drain, and crypto is being starved by a strong dollar and smart money hedging, where is the capital actually flowing? It has to go somewhere.
It does.
And the answer seems to be quietly building in the physical world, commodities. This is where things get truly disruptive for the broader economy.
This is honestly the stealth move of the year. I mean,
Yeah.
while everyone is agonizing over AI software stocks, commodities are just quietly surging.
Right.
Wheat is up 24% year to date. Oil is up 24% year to date. Over one weekend alone, hyperliquid exchanges showed oil jumping $2 purely on geopolitical headlines.
Let's look at the rational, purely mechanical case for oil to hit $150 to $160 a barrel. It sounds completely hyperbolic on its face, but the math is actually terrifying.
It really is.
Global strategic petroleum reserves have been deeply drawn down over the last few years. We essentially drained the emergency tanks to artificially flood the market and keep gas prices stable.
Exactly. But you can't run a global economy on empty emergency reserves indefinitely.
Right.
When countries are inevitably forced to refill those massive tanks in the open market, they create a highly inelastic surge in demand. And that sudden demand is going to hit a supply chain that has been chronically underinvested in for a decade.
So the capacity just isn't there.
The physical supply simply isn't there to handle a massive restocking cycle.
And this imminent supply shock collides head-on with what the data is calling the new Kevin Warsh Fed. The expectation is that Warsh, as the incoming Federal Reserve Chair, will execute a play-action-pass strategy.
The play-action pass.
I actually love this analogy. In football, you fake the run up the middle to draw the linebackers in, purely so you can throw the ball deep over their heads. How does a central bank execute a play-action pass?
So Warsh is expected to aggressively tighten monetary policy cyclically right now, perhaps hiking rates or holding them uncomfortably high in the short term.
That's the fake run?
That's the fake run. He wants to crush any lingering speculative demand and completely restore the Fed's credibility as a ruthless inflation fighter.
Okay, and the pass.
Once the market is convinced the Fed is incredibly hawkish,
Yeah.
it gives him the structural room and the credibility to execute massive necessary easing down the road. That's the deep pass.
But here is the absolute collision course. We just established that the AI capex bubble, and all the money being spent to build out artificial intelligence infrastructure, data centers, cooling systems.
Oh, it's astronomical.
Right. It's projected to hit $800 billion by 2026. That is 2.5% of the total U.S. GDP. So you have $800 billion pouring into incredibly power-hungry AI infrastructure at the exact moment global oil reserves are tapped out. A $150 oil shock would completely paralyze the Fed's ability to execute that play-action pass, wouldn't it?
It is the ultimate nightmare scenario for a central bank because it exposes the critical difference between demand-driven inflation and supply-driven inflation. Well, the Federal Reserve's primary tool is the interest rate, right? If inflation is caused by cheap credit people buying too many houses and cars, you raise rates, borrowing gets expensive, demand cools, and prices drop. But a $150 oil scenario is a physical supply shortage.
Yeah, raising interest rates doesn't magically pull more oil out of the ground.
Exactly. If energy prices double because of a physical shortage, everything gets more expensive. Transportation, manufacturing, agriculture.
It bleeds into everything.
Right. So if the Warsh Fed is forced to deal with a historic supply-side energy shock while simultaneously trying to manage an $800 billion digital infrastructure bubble, they are backed into an agonizing corner.
What are their options?
Honestly. Do you hike rates to the moon to kill the energy inflation, thereby bankrupting the tech companies trying to build the AI infrastructure? Or do you drop rates to support the tech sector and let energy prices run into hyperinflationary territory?
Wow.
It forces every institutional investor to reevaluate their entire macro playbook.
That is a staggering macroeconomic trap. Okay, let's recap the actionable takeaways from this deep dive, because we covered a massive amount of ground today.
We definitely did.
First, respect the S&P 500 supply zone at 7613. Until we break and hold above that level on high volume, we are stuck in a choppy range, and the smart money is hiding in utilities.
Yep.
Second, look for algorithm-driven price anomalies. When a machine misinterprets a capped call, like we saw with DOCN, human analysis provides a massive edge. Third, don't fight the negative smart money positioning in crypto. Wait for the charts to confirm a trend rather than trying to catch a falling safe.
Let the market prove it to you.
Right. And finally, keep a very close eye on the stealth rotation into commodities and the looming threat of a global supply shock.
And I want to leave you with a final thought to mull over as you watch the charts this week. We just discussed an AI infrastructure bubble consuming 2.5% of the entire GDP, alongside the very real mathematical possibility of oil ripping to $150 a barrel as global reserves run dry.
Yeah.
Ask yourself this. If the physical world simply cannot generate enough raw energy to support the digital world's infinite expansion, which market breaks first? The hyperscaler tech stocks funding the AI dream, or the everyday consumer paying the soaring energy bill?
That is a phenomenal question to end on. Remember, you can't just trust the calm green numbers on a digital dashboard. You have to understand the liquidity currents shifting underneath. Thank you for joining us on this deep dive. Keep your eyes on the charts and keep your minds open.